Today I wanted to talk about the growth outlook for the Australian economy for 2022 and beyond. You know, we recently released our new forecast for that growth story following the release of the national accounts for the September quarter 2021. And we've taken two approaches in working out that growth story. Firstly, from a top-down perspective. And when we think about the top-down perspective, it's really where we see the economy relative to where we saw it pre-COVID. So pre-COVID in December 19, we thought that the economy would expand by 7.8% between December 19 and December 2022. Now we think it'll expand by 8.5% over that period. So why do we think it's going to be an even faster expansion, despite the fact that that period covers the COVID contraction? Well, I think on the negative side over that period, we've got a long period of very low population growth, reflecting the closure of the borders. We've also got the likelihood of a substantial scarring in the business sector, as many businesses don't make it through that COVID period. And I think we'll continue to see caution amongst the household sector in terms of the risks of any new strains. So that should mean that growth profile should be lower than we were expecting before we knew about COVID. But of course there's been some positives over that period. And of course the big positive has been the government support for the economy, which is around $350 billion based on both federal and state government support. And then of course we've seen from the Reserve Bank near zero interest rates over most of the period, which of course has brought down mortgage rates and strongly supported the housing sector. So that's why we think that the economy can grow by more than we expected even pre-COVID. Even if we look pre-Delta, we're expecting that before we knew about Delta, we thought the economy would expand between the June quarter 2021 and December 2022 of around 5.5%. We now think that'll be 6.6%. So that's a top-down approach. What does that actually mean for the growth forecast for the final quarter of 2021 and for 2022? Well, we think that'll mean 2.3% strong growth in the December quarter, and then in 2022, 6.4%. Now that's an eye-popping number, but think about it. In the year to the June quarter 2021, the economy expanded by 9.5%, and consumer spending lifted by 15%. So it just emphasises the huge volatility that we've seen through this COVID period. But I think the 6.4% is certainly higher than we've seen from other sources. For instance, the Reserve Bank is expecting 5.5%. What about if we look at it from bottom up? Well, I think the key thing there is the household savings rate. Since the June quarter 2020, the household savings rate has averaged around 17%. Now that compares with normal household savings rate of around 6 or 7%. So per quarter, the household sector has been saving about 10% more of its income than we've seen in the past. And that money is ready to be spent. And that's the key reason why we expect that household spending in 2022, consistent with the 6.4% GDP growth, can reach 9.4%. Consistent with that, we expect that business investment will be up by 8.5% as businesses embrace strong demand from the household sector, as we see strong infrastructure investment, as businesses take advantage of the attractive tax arrangements that are available until June 2023. Why wouldn't the growth in fact be even stronger? With that sort of household savings rate, you could believe that the household savings rate could fall from its current 19.8% down to even lower than the 9% we're expecting by the end of 2022. But I think there will be limits on how much we can see in spending because of supply constraints. And it'll be that interaction between very strong demand and those supply constraints, both in the labour market and in the goods market, that'll push up inflation and wages growth. So over that 2022 period, we're expecting that underlying inflation and wages growth will get close to that 3% level by the end of 2022. And that, of course, is a signal for liftoff for interest rates. So since June this year, we've been expecting that the Reserve Bank would be raising interest rates from the February board meeting 2023, and that remains our view today. Of course, the market has a very different view. The market is assuming, I guess, that those inflation and wage pressures will be even stronger than we're anticipating. And that'll make the case for the first rate hike around the middle of next year, with 3 rate hikes over the course of next year. The market indeed is expecting that the peak in the RBA cash rate cycle will be around 2% by near the end of 2023. We're expecting that the rate peak will be around 1.25%. We would see that 1.25% as a sort of a neutral level, and rates above that 1.25% will be contractionary territory and will put even further downward pressure on house prices. So 2023 will be a year of rising rates, falling house prices, and 2024 will similarly be a year of rising rates and falling house prices. However, that household spending profile will still be in reasonable shape in 2023. There's going to be tax cuts. The Stage 3 tax cuts will be available by the middle of 2023, and household savings will still be at quite high levels. So we think 2023 can support household spending around 3.2% and GDP growth of 2.7%. By the time we get through the end of 2023, household savings will be back at normal levels, interest rates will be higher, and the prospect will be for even higher interest rates in 2024. House prices will have fallen through 2023, we think by around 5%. And we're expecting further falls in 2024. So 2024 is going to be the low point in that cycle. And we're thinking around 2% growth in 2024. But what are the risks? The risks, of course, are what the market is telling us. That the inflation and wages story will take off a lot more quickly than we're expecting, making a case for RBA rate hikes a lot earlier. And that rates will need to go well into contractionary territory. That, of course, would significantly change the growth profile, the labour market profile, and of course the house price profile. So these are the risks that we'll be watching as we go through 2022. How extreme are these imbalances between demand and supply? How quickly will those inflation and wage pressures reach a point where the Reserve Bank needs to take action? We believe the first quarter of 2023. The market believes a different number. So 2022, as with other years, is going to be very interesting. But I think the most important point is that it's going to be a year of very, very strong growth around our 6.4% forecast. Thank you.